A recent study found that nearly 80% of all overdraft fees are paid by just 9% of customers. Think about that. A tiny fraction of account holders are generating the vast majority of a multi-billion-dollar revenue stream for banks. This isn't an accident. It's a design feature. You probably think your bank is a neutral utility, a safe place to store your money and get a loan. But that's only half the story. In reality, your bank is running a complex segmentation model on you and every other customer. Your value to them is calculated, and the service you receive is a direct result of that calculation. For most people, the bank is a transactional business that profits from your mistakes. But cross a certain invisible line, and the entire relationship inverts. The bank stops being a vendor and starts being a partner that actively competes for your business. Today, we're pulling back the curtain on the hidden tiers of banking. We'll show you the exact net worth thresholds where everything changes, the different rule books they use, and how the wealthy access a financial system you might not even know exists. The core of this system is your investable assets. This isn't the value of your house or your car. It's the liquid wealth you have in cash, stocks, bonds, and other investments that a bank could potentially manage. This number, more than your income or your credit score, determines which rule book they apply to you. To the bank, you are one of two things: a potential source of fee revenue or a potential source of asset management revenue. There is almost no in-between. Every product, every interaction, and every fee structure is designed to optimize their profit based on which category you fall into. For the 91% of customers paying very few overdraft fees and holding low balances, the bank's profit model is built on volume and standardization. They need millions of you to make the model work. To understand the system, you need to understand the tiers. These are the invisible walls inside every major financial institution. At the bottom is retail banking. This is for everyone with under approximately $100,000 in investable assets. The service is standardized, digital first, and designed for efficiency. You interact with tellers or call center agents who have no persistent knowledge of you. The bank's primary goal here is to minimize the cost of serving you while maximizing fee-based income from things like overdrafts, monthly maintenance, and wire transfers. You are, in blunt terms, a number in a very large database, and the game is to make that number profitable through automated, small-scale transactions. The first significant jump is to the mass affluent tier. This typically starts when you have between $100,000 and $1 million in investable assets. Here, the rules begin to bend. You might get assigned to a specific financial advisor at a local branch. Many of those pesky fees for checking accounts or wire transfers suddenly get waived. You might get a slightly better interest rate on your savings or a discount on a mortgage. The bank is starting to see you not just as a source of fees, but as a potential long-term investment client. They are playing the long game, offering you perks to keep your growing assets with them. You're no longer just a transaction. You're a relationship worth cultivating. You might even get small lifestyle perks like a Citigold client using their Culture Pass for free entry into a New York museum. The real transformation happens when you cross the high net worth, or HNW, threshold. This is the entry point to the world of private banking. The minimum is typically $1 million in investable assets, but for elite institutions, it's much higher. Bank of America's private bank requires at least $3 million. J.P. Morgan, private bank, sets the bar at a staggering $10 million. At this level, you are no longer a customer of the bank. You are a client. You don't go to the bank comes to you. You are assigned a dedicated private banker, or even a full team of specialists, an investment strategist, a wealth planner, a trust officer. Their compensation is directly tied to keeping you happy and growing your assets. At the absolute peak of the pyramid are the ultra-high net worth individuals, or UHNWIs. The threshold here is usually between $25 million and $30 million. Morgan Stanley's private wealth management, for example, requires $20 million just to start the conversation. For these clients, the bank functions less like a bank and more like a personal chief financial officer or a multifamily office. The services are completely bespoke. We're talking about institutional-level investment management, coordinating with lawyers and accountants for complex, multi-generational estate planning, setting up philanthropic foundations, and providing specialized financing for acquiring fine art, yachts, or even sports teams. The bank's goal is to become so deeply integrated into the client's financial life that leaving would be almost unthinkable. So, what is the deep mechanism driving this dramatic shift in service? It's the inversion of the profit model. For a retail client with a $2,000 balance, the bank might make, say, $50 a year from various fees. To serve you, they have to maintain branches, apps, and call centers. You are a low-margin, high-volume product. Now consider a private banking client with $5 million in assets under management, or AUM. The bank charges an advisory fee, typically around 1% of AUM. That means this single client generates $50,000 in revenue for the bank every single year. That's 1,000 times more revenue than the retail client. Suddenly, it makes perfect economic sense to assign a dedicated team, answer their calls on the first ring, and offer them the best possible service. You've shifted from being a cost to be managed to an asset to be protected. This difference in value also dictates the service philosophy. In retail banking, the model is reactive. You have a problem, you call the 800 number, you wait on hold, you explain your issue to someone who has never spoken to you before, and you hope they can solve it. The entire system is built to handle problems at the lowest possible cost. In private banking, the model is proactive. Your private banker is expected to anticipate your needs. They monitor your accounts for unusual activity. They call you with investment ideas. If a mistake happens on the bank's end, you don't call them. They call you. This is the famous apology call, where a senior manager will personally contact a client to apologize for even a minor inconvenience, ensuring the relationship remains intact. The client-to-advisor ratio tells the whole story. In retail, it's effectively infinite. In private banking, one advisor might handle only 30 to 50 clients. Perhaps the most significant structural difference is what you're allowed to buy. The financial world is split into public markets and private markets. As a retail investor, you're generally restricted to public markets, stocks, bonds, and mutual funds available to everyone. Private markets, like venture capital, private equity, hedge funds, and direct real estate deals, are legally off-limits. These are considered alternative investments, and they are where a significant portion of the world's wealth is generated. To access them, you typically need to be an accredited investor, which in the U.S. means having a net worth over $1 million or an annual income over $200,000. Your private bank doesn't just give you advice. It acts as a gatekeeper and a guide to these exclusive opportunities, which have the potential for much higher returns, albeit with higher risk. The wealthy don't just have more money to invest. They have a completely different menu of things to invest in. This tiered system creates feedback loops that can accelerate wealth generation for those at the top and create headwinds for those at the bottom. The fees that drain wealth from low balance accounts are the very same profits that subsidize the white glove service for H&W clients. Access to private markets can generate returns that are structurally unavailable to the average person, widening the gap. Favorable lending terms like portfolio loans allow the wealthy to seize opportunities without liquidating their appreciating assets, a luxury the retail customer doesn't have. It's a system where advantages compound. The more money you have, the more tools the bank gives you to make even more money, more efficiently, and with better service. It's not a conspiracy, It's just the logical, profit-maximizing design of the modern financial machine. Let's make this concrete with a tale of two customers. First, meet Alex. Alex has $500 in a checking account. One day, a $40 subscription renewal hits the account, overdrawing it by $5. The bank immediately charges a $35 overdraft fee. Alex's small mistake has cost 700% of the overdraft amount. Now, meet Ben. Ben has $5 million in a brokerage account with a private bank. He wants to buy a vacation home for $750,000, but doesn't want to sell his stocks and trigger a massive tax bill. He emails his private banker. Within hours, the bank offers him a portfolio line of credit, allowing him to borrow against his investments at a very low interest rate, maybe 2% above the benchmark. Ben gets his house, his investments continue to grow, and he avoids the taxes. Same institution, two completely different worlds. This extends to every major financial product, especially lending. A standard retail customer applying for a mortgage is fed into a rigid algorithm. Your FICO score, your debt-to-income ratio, your job history, these data points produce a simple yes or no. There is very little room for nuance. A private banking client gets a custom mortgage. Their banker doesn't just look at a credit score. They look at the entire relationship. They see the $5 million in assets. They understand the client's business. They can approve loans with unconventional terms, like interest-only payments or balloon structures that would be impossible in the retail system. The algorithm says no, but the relationship manager says yes. This flexibility is an enormous, often invisible advantage. The divergence isn't just in core financial products, it's in lifestyle and access. Your experience of the bank as a physical or social entity is entirely different. For most, a trip to the bank means waiting in line for a teller. For a UHNW client, it could mean an invitation to a private art gallery viewing sponsored by the bank. It's a curated networking event where they can meet other influential business owners, artists, and investors. The bank isn't just managing their money. It's enhancing their social capital. The goal is to create a golden handcuff of value-added services that go far beyond banking. These perks create a powerful sense of belonging to an exclusive club, making the client less likely to ever switch to a competitor. Let's trace the journey of a hypothetical entrepreneur, Sarah, to see how this plays out in real life. At 25, Sarah starts a tech company with a basic business checking account at a major bank. For years, she's a retail client, paying monthly fees and dealing with standard customer service. By 35, her company is successful, and she has over $300,000 in her personal investment account with the same bank. She has crossed the mass affluent threshold. A branch manager notices and invites her in to meet a financial advisor. Her account fees are waived, and they help her set up a more sophisticated investment portfolio. She feels valued for the first time. At 45, she sells a portion of her company for $8 million. The very next day, a vice president from the private bank calls her. The local advisor is gone. She now has a dedicated team in the city's financial district. They help her manage the windfall, provide a portfolio loan to buy a new headquarters, and introduce her to estate planning lawyers. Sarah's relationship with her bank has transformed at each wealth inflection point, mirroring the evolution of her financial life. Now, let's dismantle a common misconception that all bank accounts are basically the same, just with different fees. This is fundamentally wrong. A retail checking account is a standardized product like a can of soup on a grocery store shelf. There are millions exactly like it. A private banking relationship is a customized service. It's like having a personal chef who designs a menu based on your specific dietary needs, preferences, and goals. The product versus service distinction is everything. One is built for scale and interchangeability. The other is built for depth and personalization. The tools, the access, the advice, and the human element are not just incrementally better, they are categorically different. Another misconception is that private banking is exclusively for the old money heirs or tech billionaires you read about in magazines. The reality is that the client base is much broader and often includes first-generation wealth creators. The typical entry point is $1 million in investable assets, a threshold reached by many successful doctors, lawyers, entrepreneurs, and corporate executives. These are not necessarily people who inherited fortunes, they are people who are actively building them. In fact, a 2023 report noted that banks are scrambling to adapt their service models to cater to this growing population of new money, HNWIs, who often have different needs and expectations than traditional multi-generational wealth clients. Finally, let's confront the uncomfortable truth that nobody likes to say out loud. The banking system is not designed to be fair, it's designed to be profitable. The way the bank treats you is a rational economic response to your balance sheet. It is not personal. The system is designed to extract maximum value from you at every level. For those with low balances, the most efficient way to extract value is through high margin fees on common mistakes. It's a penalty-based model. For those with high balances, the value is extracted as a percentage of their success, a fee on their growing assets. It's a partnership-based model. The bank isn't your friend or your enemy. It is a mirror reflecting your financial position back at you. The rules of the game are clear, even if they aren't always advertised. So, what's the takeaway? The goal is not to get angry at the system, but to understand its rules and use them to your advantage. Your primary financial objective should be to cross the thresholds that change the bank's relationship with you, from a transactional customer to a valued client. First, focus relentlessly on building investable assets. It's this number, not your salary, that unlocks the next tier. Second, once you approach a threshold like $100,000, proactively ask what relationship benefits you qualify for. Don't wait for them to offer. Third, understand that the ultimate financial hack is to align the incentives. You want to reach a point where the bank makes more money when you succeed, not when you fail. This is the fundamental power shift from paying fees to paying for advice. This is how you make the system work for you instead of against you. This shift in perspective is crucial. Which best describes your current view of your banking relationship? Let me know in the comments. A. The optimizer. You're already leveraging relationship benefits at your current tier. B. The accumulator. You're focused on hitting the next asset threshold to unlock better services. Or C. The awakened. This completely reframes how you see your bank's role in your financial life.